The Honest Money podcast is powered by 10x Investments, a licensed financial services provider. Consult with your financial advisor and let's 10x your future together.
Welcome to Honest Money. We're talking today to one of my favorite repeat guests on Honest Money. His name is Chris Rule, and he's head of client solutions at 10x Investments. Chris, thanks so much. It's great to have you back on the show.
Yeah, thank you for having me again. It's always a pleasure to be here, Warren.
And nowadays, with podcasts, what's interesting is that a lot of the time they're actually watched on platforms like YouTube and the like. So I'm just going to say I appreciate you getting a nice haircut and a good shave there, Chris. It's great to see the lean, slick version of you and not the fuzzy one like I normally am. So we'll both put our best face forward.
Yeah, no, you got to polish and clean up when you're on the Honest Money. So, absolute pleasure. And apologies if you're staring into my guest bed here. It was the option for this morning. I'm off to Joburg this afternoon. So little work from home session and then off to Joburg.
The life of a traveling executive.
Yeah, exactly.
Chris, we're going to talk a little bit about a new theme, which is kind of building momentum around the asset management industry. And what's interesting to me as an investor with a fairly long history now in this industry is there are themes that seem to come up and become very dominant for a while, and then they fade away. Sometimes themes build up and remain, and they become part of the fixture of the investment industry. And so we're going to be talking about the phrase, and I guess I want to be careful here to say that it's not just a marketing slogan, but we're going to be talking about investment solutions, and those are often useful and often have a purpose and deliver on a goal, but sometimes they're just marketing jargon. It's taking an old product, sticking a new label on it, and pitching it to investors as something new and fancy because other companies are talking about investment solutions. And it does remind me when we look back at a theme which is sort of fading fast, it feels like around the whole ESG investments. Not that ESG is gone as a theme, but there was this thing of greenwashing, and so the question is, is investment solution now the same as greenwashing was a little while ago? And maybe then just to ask you, what was greenwashing? We don't need to get into kind of a deep discussion about it, but just a little bit of context around that.
So greenwashing was very simply in many senses a marketing ploy to make something that wasn't ESG look and feel like it was ESG. So quite literally, if you think of the description of greenwashing, it was painting a fund green or a process green that in reality wasn't really, and the objective wasn't ES or G. And so there was a lot of pressure from fund buyers to make sure that investment funds were ESG friendly, and the clever marketing and distribution people said, well, we've got some stuff that kind of looks like it's ESG. Let's make this fund look green. And so greenwashing was this big term which tried to effectively catch that big trend of allocating capital to environmentally, social, and governance conscious funds. And it was something that was huge 3 to 5 years ago, and now we've seen it die right back. So it is interesting, but in the end, greenwashing was a critique on what was more marketing and distribution than substance in the underlying investments of the fund.
And I think that that's going to be something that repeats in cycles over many years. It has done in the past, and it certainly will do it into the future. I kind of smile when I think about when the term artificial intelligence or AI became kind of really prevalent in the world. Suddenly there were lots of companies that added AI into their tagline somewhere, and whether they were making nuts and bolts, they were suddenly making nuts and bolts with AI, and I don't know how they did that, but they were. And the investment industry, isn't immune to that. So when there is a theme that catches people's eye, and when you add, whatever the theme is to your product range, and you start to attract assets, then competitors look around and go, well, hang on, We don't want to lose out on those assets. We don't want, our competitors getting all the money. We want to get that money as well. And so they release their marketing geniuses onto their product range and come up with something that looks like the theme of the moment. And so it reminds me a little bit of someone who's got a car manufacturer that's got a perfectly good little hatchback, and suddenly everyone's buying SUVs. So they kind of change the paint on their hatchback and put some plastic bumpers on it that make it look rough and ready, and then talk about a crossover. And all it is a hatchback. And I think that's the thing we're talking about today is how do we make sure that if we want a proper SUV, we buy an SUV, and we don't just buy a slightly more expensive hatchback that doesn't do anything on an off-road. And that's really where we're getting to now, is around investment solutions. I mean, I like the theme, I like the idea. When we're investing, as a private investor, I don't really care about all the jargon that's important to asset managers. I'm investing my money for a particular objective, and I want to know that once the money's invested, that I've got the best chance of getting an objective. And to me, that's an investment solution, Chris.
Yeah, exactly right. And I think the idea that a solution might fit your need doesn't necessarily make it a solution. So, I think to get through all the marketing spiel, because we see a lot of this talk about investment solutions, you really do need to lift the hood a little bit and understand what the fund or the platform is intending to do. And again, to be a solution, you really need to be solving for a very specific goal. And that thing that you said right there is the important part. It's to solve for a goal with the highest level of certainty or probability. So it's not about outperforming that goal or about trying to achieve some aspirational dream above that goal. And a lot of our industry has been centered around this idea of, if you outperform a reasonable return objective, you have this aspirational component to having excess capital. And that's great. It is great. When you have it, it's great. But the reality is it's not about trying to outperform it. It's about trying to lock in certainty in your financial journey. I was trying to think of an analogy, sort of a simple analogy. And the one I thought about is, it's your wedding day, and you've got to get to the church, and you've got to get there on time, right? Now you've got driver A, and you're at home, and you've got your groomsmen and your father and mother or whatever it is, and driver A says, you know what, Chris, I'm going to get you to this church, and I'm going to ensure with a probability of 90%, because you never know what can happen in this world. So let's not be bold and say 100%. I'm going to get you to the church 10 minutes early. You're going to be there looking calm and relaxed, waiting for your bride to come down the aisle. Okay, that's great. So driver A, he's solving for your need to get to church on time. Driver B comes along and says, Chris, guess what? Tap on the shoulder. I'm going to get you to the church, but I'm going to probably try and get you there 30 minutes earlier so you can have a whiskey outside on the lawn before. And that'll be wonderful because, you can enjoy the moment and it's a beautiful day. But the only thing is I need to do some bold overtakes, and I'm going to have to take a shortcut through town, and we might hit traffic. So, I'm going to give you a 50% probability you're going to get there 30 minutes earlier, a 60% probability you're going to get there 10 minutes earlier, but there's a 30% chance you're going to be late. What do you choose if you are, the groom on the day? Don't ask everyone this question. Most people are going to go, I'm taking the 90% chance. I'm 10 minutes early. And it's the same with your financial journey. You could picking a fund that is a solution-based fund, which is just trying to achieve the goal it sets out to. That's it. Versus a fund without performance potential is the same kind of trade-off in a sense. It's looking at your financial journey and saying, well, what actually matters to me and what can't I afford, as opposed to looking at all the other stuff that's very alluring. And I think that, maybe a silly analogy, but it is a way of thinking of slicing and dicing. If you apply the same logic to an outcomes or a solutions-based investment manager versus an alpha or outperformance-based manager, you're going to find similar analogies on the table, a similar theme.
So when I'm looking at a website with a bunch of investments that are available to me, or someone's, most likely for a lot of us, we'll be proposed a solution or an investment from an advisor. I'll be looking at it, and the words I'm going to see there will not just be, it's ABC fund managers, best performing fund. Nowadays, that will be the ABC fund managers income fund, or it'll be the retirement income fund, or it'll be the long-term inflation plus 3 outcome. Is that what we're talking about when we see these sort of labels on these fund boxes?
Yeah, absolutely. And I think if you simply pull up a fact sheet or a MDD and you read the fund objective, you'll get a sense of what the manager is actually trying to do. Usually, if there's a strong tie into CPI, those are typically outcomes or solutions-based managers. And you can see the language of how they define the objective of a fund is usually around a real return objective. And, that's what the fund is intending to do. And usually it will say, we aim to meet this real return objective, not we're going to aim to outperform it by some hurdle. If you contrast that with how most of the funds in our industry are set up, it will say the objective of this fund is to outperform an CISA category or to outperform, an ALSI benchmark. And that's more of your alpha-centric, your outperformance manager. I mean, there's a place for everyone, but that is not, in my mind, an investment solution, because if you can't solve for something with high probability as an investor, then that doesn't necessarily back solve your need. And then, of course, there's this idea of, I guess there's common goals in the investment industry. So retirement is a very common goal, pre-retirement, let's say. So a high equity Reg 28 fund is in many instances a retirement solution, right? And we should see it as such. But again, if you go under the hood there and you look at those managers, there's a reason why high equity funds are CPI plus 5. It's because if you look historically at the asset classes that you're constrained to within Reg 28 and high equity, you shouldn't reasonably be expecting to outperform real 5% in real terms. And so solving for that particular outcome is to say, well, we're going to deliver you CPI plus 5 over every 5-year rolling period. That's what we can actually promise you. So that would be an outcomes or a solutions-based manager. Someone else who says, we're going to outperform their CISA peer group and we're going to outperform CPI plus 5. That's not a solutions-based manager, because in the end, that manager is going to take risks and they're going to have to take different allocations that reduce the probability of outperforming CPI plus 5. So it's nuanced. I'll totally admit that. And for the investor, it's a little bit complex, but not all funds are created equal. And I think this is just another example. I think what we've seen is investors, and this is a huge global trend, this is not just in our market, but investors have moved away from necessarily chasing the allure of alpha to more saying, well, and this is a function of a lot of things, but transparency and education and the global financial crisis, there's been so many trends here. But saying, well, actually what's really important is that I've got certainty in my financial journey. And so as investors have moved away there, this idea of selling alpha or selling the allure of outperforming something has dropped away. And so the clever marketing people again have said, well, guess what? We're a retirement solution. When actually the manager is an outperformance or an alpha chaser. And I'm not bashing one or the other. There's different horses for different courses. But I do think investors need to be aware that if a manager is not speaking in probabilities and certainty, they're probably not a solutions manager. They're probably an alpha manager.
So let's just explain some of those, because you're using some important terms there. So the one is, when we talk about alpha, that's saying, I've got a fund and it's going to target the all share index as a benchmark. And what I'm proposing is that my fund is going to try and beat the all share index over a 5 or 10 year period, whatever it is. And if you manage to achieve that outperformance as a fund manager, then you've delivered alpha. You've done the thing that you're hoping to do, not promising, but you're hoping that you're going to do better than a particular market. And so your reason to exist as a fund manager in that case is you are saying that you're hoping and projecting that you can do better than a let's say a market related benchmark. That's where you deliver growth, and growth in this instance, the fund managers have to have jargon, Chris, so they call that alpha. And someone else who says, look, my job is just to achieve an objective, and it might be the all share index. So what I want to do is I'm going to give you an investment that's going to deliver the same return as the all share index. Then they don't call that alpha, they're going to call that beta, if I'm right, that they just say we're delivering the growth of the market, whatever it is. And it could be the stock market, the bond market, the property companies, etc. And then the last category, which is what we're talking about here, is you get a fund manager that says, I'm not trying to beat a particular sets of benchmarks or stock market benchmarks or returns. What I'm saying to you is, here is inflation, and they're not just going to say inflation, they're going to say CPI. And I think that I've got an investment solution that will be able to deliver a growth rate of 3% a year above CPI. So if CPI is 6, I don't think it's going to be 6 anymore, but if it is, and I'm going to deliver CPI plus 3, in other words, I'm aiming to deliver you 9% a year for the next 5 years. Not a guarantee, but I believe, if I'm a fund manager, that I'm constructing the fund and the portfolio of investments inside to give me the highest chance, and they're not going to say chance, they're going to say probability, but the highest probability of being able to achieve that. Again, no one's offering guarantees. That's not the game here. No one's misleading anybody. They're just saying, we're aiming to do this, and we believe, with our history and with the history of studying markets, if we put this portfolio together in this particular mix, we've got a very good chance of being able to deliver on the objective. We're not aiming to do better. We're just aiming to deliver. If I'm a client, that's attractive because I'm planning my life or my expenses, or use your wedding example. If I'm saving now for that wedding in 5 years' time, I've got a fixed amount of money that I need to be able to spend on a particular time. I'm not really interested in a fund manager that says, look, I've got a fairly good chance of giving you better than the stock market or half of the stock market return. What I want is someone that says, here's a fairly good chance I'm going to deliver a certain amount of growth on your investments over a certain amount of time. If life works out according to plan, you can not quite bank on it, but you can be reasonably sure you're going to get that outcome on your money. Is that a good summary?
Totally. No, that's pretty much spot on. I think, and I do think it just comes down to this. What you unpack there really is the objective of the portfolio, and that last portfolio objective is very centered around achieving that CPI plus return hurdle. So, the temptation to take on more risk and achieve CPI plus 4, for example, it doesn't exist for that fund manager, because their job is not to outperform that. It's actually go and seek out CPI plus 3 with the highest chance or certainty. And so that's very important in terms of how the portfolio is constructed, how the fund manager is thinking about how they're putting that portfolio together. That temptation of seeking outperformance or alpha relative to your goal, it falls away. And so your probability of achieving that goal, your chance of achieving that goal increases. Even though, and this is where the temptation will exist for clients, even though that first manager, that alpha manager you described, at the end of a 10-year period might actually produce a better result than the outcomes or the CPI plus 3 manager, because that's their job. But the probability is that they won't. We know that, because you need to take on risk to outperform a goal, and that risk is at your expense in the end. It's not really at the fund manager's expense. And so I think that's where the tension exists and where the trade-off exists. And I think what we're trying to talk about today is, as an investor, if you're seeing a fund or a new great brochure that says your retirement solution, and that solution is about alpha and not about achieving your realistic return objective with a high level of certainty, well, then that's not necessarily a retirement solution. That's probably one of the falls into the camp of one of these alpha managers, and that alpha is absolutely achievable. We've got great managers in our market, but the reality is, for you as the investor, you need to understand that they're not actually trying to achieve a retirement hurdle. They're trying to outperform a retirement hurdle, and they take the risk of underperforming it. And that's kind of the big separation here.
I'm going to take my SUV and your wedding analogy and use that to kind of circle back. So what we're saying here is, if you're standing at the reception of your house, Chris, and you're about to get married, and it's my job to get you there, I'm either arriving in a sports car with very little protection, no airbags, and no real roof or anything, and some brakes and some suspension, but a heck of an engine. And then I say to you, Chris, get in. I'm going to get you there, come hell or high water, unless we have an accident. And then someone else arrives with a nice little SUV that's not that fast. It's got lots of airbags, lots of brakes. It's got a very good GPS, and it says, I'm going to get you there. We're not going to be fast, but we're going to get there on time and safely. And if there is an accident, you'll be okay because we've got all the safety features that we need. And as an investor, your choice is one or the other. And you could be in the sports car that gets you there with a heck of a ride very quickly. But there is a much bigger chance that something goes wrong. And so I always think with investors, a lot of us crave some kind of certainty, some kind of understanding of where we're going to be into the future. And when we know that the future is so uncertain, a product that pitches itself, that promotes itself as giving you some certainty is very attractive. And I can understand the marketing drive to offer that to investors. But I think your point is so valid here, is you can't just take what it says on the name and just say, okay, so this is a retirement solution or it's an income solution. You've just got to do a little bit more reading into that to look at what they're talking about, look at how they're constructing that portfolio for you. And if all of their talking is around outperforming as opposed to reaching an objective, you need to know that you might not have the actual vehicle that you're hoping for, you're aiming for. And so I think it's an important topic. We try and shy away from jargon in honest money, but at the same time, we have to explain that jargon and make sure that you know what you're buying when you buy an investment. And I think you've summed it up beautifully, Chris. Thank you very much.
I mean, my sort of parting comment is what it really starts with, though, and this is where obviously the advice component is so important, but from an investor's perspective, is so important. Is knowing what you need to achieve. So back to the wedding analogy, you knew what you needed to achieve there. You just needed to get to the church on time, right? That was what you needed to achieve. And it's the same with investing. If you've got clarity around your objective, well, then you can solve for that objective. If you don't have clarity around what your objectives and your requirements are, sure, then it's very difficult to create an investment solution because no one really knows what you're trying to solve for. So sometimes the whole hardest objective is, I've got way too much money, I just want to maximize growth. And then you go, well, okay, it's actually a bit more difficult than saying this is all I need is to retire in 30 years with this much money and this is my return objective. These are my constraints, and sure, off you go. So knowing that objective, knowing what you need to do and creating clarity in those financial goals is super important to fitting how the solution then fits. And then you can actually match your needs with what the market is showing you or what your advisor is showing you.
I think that's a great point to end. Chris Rule, head of client solutions at 10x Investments, not head of 10x. That's someone else's job for now. Appreciate your time. Thank you so much for explaining it to us. I actually must say that I learn all the time going in this industry. It never stands still, and I think that our listeners would have got a lot of value out of this. Appreciate your time.
Thank you, Warren, and thanks to the listeners.
The Stradivarius violin is considered to be the most emotive instrument in the world. That's why you'll often hear it in investment ads, adding drama and the utmost importance to their philosophies, or for the announcement of a fancy new fund manager. 10x Investments don't need dramatic instruments to seem impressive. They let the results sing for themselves. So 10x your future without the drama. 10x is a licensed FSP.